The dollar is telling you one story on the screen, but the funding spreads are confessing a different one right now in real time. And that's the conflict nobody wants to sit with, because it wrecks the easy take that USD up means stress, USD down means relief. That rule of thumb is a bedtime story. The grown-up version is messier. The dollar can look calm, even soften for a week, while the global system is quietly paying a higher and higher toll to borrow, roll, and hedge dollars under the surface. And once you learn where to look, you can't unsee it. Because if one specific pressure point snaps over the next couple of weeks, the math changes for everything from emerging market FX to commodities to the most boring, developed bond market on Earth. Stay with me, because later I am going to give you the clean checklist for the next 7 to 14 days. What level matters? What would confirm the squeeze? What would invalidate it? And where the stress tends to show up first when the headlines are still asleep. Here's the core idea. You don't watch $1 chart. You build a dollar stress map. Think of it like weather radar. You can look out the window and see blue sky and still have a storm cell forming 10 miles away, moving fast, carrying hail. Spot FX is the window. The stress map is the radar. And the radar is built from the plumbing: FX swap pricing, cross-currency basis, repo conditions, the collateral chain, how corporates roll funding, and where the need for dollars is non-negotiable. Because a real dollar shortage is not an opinion, it's a forced bid. It's someone paying up because they have to. That's where the real pressure starts. Now, price context, because we are not doing vibes. Recently, the broad dollar story has looked confusing on the surface. You've seen stretches where the dollar index drifts lower, enough to spark the usual narratives about rate cuts, risk on, diversification, pick your headline. At the same time, you watched USD JPY whip around in that dangerous zone that keeps pulling intervention speculation into the room. We just had another reminder of how violent that can get when authorities even hint at stepping in. One sharp rally in the yen, and suddenly everybody remembers that FX is not a free market when a major country decides it can tolerate the speed of the move. And in the US funding backdrop, overnight rates like SOF are sitting in that mid 3% neighborhood, which sounds boring until you realize that boring can still hide stress when the distribution of trades shifts and the system starts paying up for the same dollars on the same collateral. But that's not the part that matters. The part that matters is dispersion. Dispersion is a stress signal. When the dollar looks fine in one place and brutal in another, that's not randomness. That's your map lighting up. A shortage doesn't announce itself as the dollar index is up 2%. It announces itself as certain players being forced to secure dollars at any cost, while other players are still trading headlines. The system is not one market. It's a chain of markets. And chains don't break everywhere at once. They break at the weakest link first. The next detail is what flips the whole setup. Here's the hidden detail that reframes the entire story. Dollar stress is not constant. It is lumpy. It spikes on the calendar. Because bank balance sheets have deadlines. Reporting dates act like gravity. Month end, quarter end, year end. These aren't just dates on your phone. They are moments when balance sheet capacity gets rationed. Risk gets repriced. And the cost of intermediate trades jumps even if nothing dramatic happened in the headline world. This is why you all see recurring weirdness in FX swap markets around IMM dates and reporting windows. It's why cross-currency basis can widen even when spot FX looks sleepy. It is why the word liquidity becomes a weapon right when you least expect it. And if you ignore the calendar, you will misread the entire film because you're only watching a single frame. So what is a dollar shortage mechanically without the mythology? It's not people want dollars. Everybody always wants dollars for something. A shortage is when the demand for dollar funding and hedging rises relative to the capacity of balance sheets to supply it, and the premium shows up in the instruments that convert one currency's funding into dollars. The simplest mental model is this. A European or Japanese investor buys a US asset, treasuries, credit, equities, anything. They may want the yield, but they don't want the currency risk. So they hedge the dollars back into euros or yen. That hedge is not free. It runs through FX forwards and swaps, and often through cross-currency swaps. In a frictionless world, covered interest parity would keep those relationships tight. In the real world, balance sheet costs, collateral constraints, and dealer risk limits create deviations. Those deviations are the spread, and the spread is the confession. Let's make it tangible. If you can borrow in your local currency and swap into dollars synthetically, the price of that swap tells you how scarce dollars are relative to the system's willingness to deliver them. When the basis moves, it's basically the market saying, sure, you can have dollars, but it's going to cost you. It's not a headline, it's a toll booth. And toll booths don't care what you believe, they care what you pay. That's why I keep hammering this. The dollar can look calm on your favorite chart while the toll quietly rises. because the people paying the toll are not tweeting about it. They're just trying to survive the roll. Now, why now? Because the calendar is the catalyst. We are in one of those windows where liquidity can thin, funding rolls cluster, and risk management becomes mechanical. When you approach month-end and reporting windows, dealers tighten. Balance sheets get precious. Hedgers who procrastinated get forced to transact. Funds rebalance. Corporate treasurers roll paper. And if you add any policy uncertainty on top, trade policy noise, central bank communication, geopolitics, then the same crowded door gets smaller right when more people are trying to exit. That is how you get sudden, violent micromoves that feel out of nowhere. They're not out of nowhere. They're out of the calendar. Because if this one level breaks, the math changes. So let's build this stress map, node by node, like a pilot checking instruments instead of staring out the windshield. First node, US plumbing. You watch repo and you watch the behavior around SOFR. Not because you're obsessed with a single overnight print, but because repo is where the system finances its core collateral. When repo gets tight, it's like blood pressure rising. You can still walk and talk at first. You can still smile on TV. But the body is under strain. Spikes, specials, unusual firmness around settlement heavy days, these are the hints that collateral is being hoarded or that balance sheet capacity is being rationed. And when that happens, the dealer community does what it always does. It raises the price of intermediation. They don't have to manipulate anything in a cartoonish way. Incentives do the work. If balance sheet is expensive, balance sheet becomes scarce. That's the mechanism. Second node, Japan, because Japan is not just a currency story. Japan is a funding engine for global portfolios. The yen has been a hinge currency for decades. When USD JPY pushes into the upper 150s, approaching zones that have historically triggered intervention chatter, it's not just a chart level. It's a stress test for a whole ecosystem of hedges, carry trades, and asset allocation choices. If Japanese investors are holding US bonds and hedging, the cost of hedging matters. If yields move and the hedge becomes punitive, their safe treasury exposure can turn into a problem. They may reduce exposure. They may change hedge ratios. They may roll hedges at ugly levels because they have to. That flow doesn't ask permission. It hits the market like a tide. And that is why you can see violent yen moves even when the dollar index looks like it's taking a nap. Different node, different stress. Third node, Europe. Europe often expresses dollar stress quietly through the swap market, especially around reporting dates. European banks and corporates have dollar needs, trade finance, funding, asset holdings, you name it. When balance sheet constraints bite, the premium for dollars shows up in basis. It's not always loud, but it's consistent. And consistency is its own kind of evidence. Because the next detail is what flips the whole setup. When you see recurring stress around specific dates, you're not looking at random volatility. You're looking at structural constraints. That is much more actionable, because structural constraints don't disappear because somebody wrote a soothing note. Fourth node, offshore Asia. This is where liquidity can get turned with policy levers, and where the system can suddenly feel like a trap door. Offshore funding conditions can tighten fast. Forward points can shift. Dollar availability in certain channels becomes selective. And once again, this is not about conspiracy. It's about policy objectives, capital flow management, and the reality that the offshore market is a pressure valve. When it tightens, the scramble for dollars tends to show up in proxy trades, regional FX, commodity-linked currencies, even parts of credit. Watch how quickly the narrative changes when one of these valves gets nudged, because the headlines will be late, but the pricing is immediate. Fifth node, emerging markets. This is where dollar stress stops being an academic discussion and becomes survival math. EM doesn't need the dollar to rally broadly to suffer. It needs rollover risk to rise. It needs external funding to get more expensive. It needs imported inflation to creep back in. It needs capital to hesitate. And when EM comes under pressure, it can feed back into the global system through risk sentiment, through commodity demand assumptions, and through forced portfolio adjustments. The key word is forced. A lot of people love to talk about flows like they're discretionary. In stress, flows become mandatory. Margin calls don't negotiate. Funding desks don't feel bullish. They pay up or they don't get the dollars. But that's not the part that matters. The part that matters is how this touches commodities and metals, the crowd you re-in if you are re-watching this. Because commodities are where dollar stress becomes physical, not metaphorical. Physical. Invoices are in dollars, trade finance is in dollars. Inventory financing, margin requirements, letters of credit. This stuff doesn't care about your macro hot take. When the cost of dollars rises in the funding channels, it changes the affordability equation for importers. It changes the working capital equation for merchants. It changes the behavior of producers who need to lock in prices and hedge. And if you're looking at metals, there's an extra layer. The paper market can stay liquid longer than the physical market can stay comfortable. When you get paper versus physical tension, the signals often show up first in spreads, premia, availability chatter, and weird divergences between related contracts. It's the same concept as the dollar stress map. Spot price is the window. Structure is the radar. Now let's stack proof, because trust is earned with layers, not with volume. Proof point 1, the swap taught basis behavior around reporting windows. You don't need perfect numbers to respect the pattern. The pattern is that the cost of swapping into dollars can worsen around month end, quarter end, year end, as balance sheet gets rationed. That is a structural footprint. Proof point 2, repo behavior and the distribution of overnight financing. When the system is flush, you see smooth funding. When the system is strained, you see pockets of tightness and elevated prints, especially around settlement-heavy days and key dates. Proof point 3, central bank backstops and swap line frameworks. The mere existence of dollar swap lines is an admission that global dollar funding markets can break down under stress. You don't need them to be actively used every day for them to matter. Their presence shapes behavior. Their testing and readiness exercises tell you the plumbing is monitored because it matters. Proof point 4, FX dispersion. When certain pairs, especially high leverage, high sensitivity pairs, start moving sharply while broad indices look mild, that dispersion itself is a sign the stress is localized and potentially spreading. Proof point 5, the behavior around USD, JPY in that upper 150s neighborhood. The market AS reaction to even a hint of official attention tells you positioning is nervous and liquidity can thin fast. Proof point 6, because we're not stopping at 5, the macro narrative whiplash itself. When the dollar can have its worst week in months on a headline set, while other parts of the system still price in scarcity, that contradiction is information. Markets can't keep two conflicting truths stable forever. One side eventually forces the other to reconcile, and that's where the real pressure starts. Now, let's respect the counter-arguments, because credibility dies when you pretend uncertainty doesn't exist. Counterpoint 1, what if this is just seasonal noise? Year-end often distorts funding. Month-end often distorts funding. Maybe the spikes fade and the basis normalizes as balance sheets relax. That happens. Counterpoint 2, what if global growth stabilizes and risk appetite returns, reducing the need for defensive dollar hoarding? Also possible. Counterpoint 3, what if the policy path in the US becomes clearer? Rate cuts, stable inflation expectations, calmer trade policy, and the market stops paying a fear premium? That could ease the strain. So what would invalidate the shortage narrative? It would look like smoother funding across reporting windows, less dispersion in FX, fewer stress reactions in sensitive pairs, and a calmer repo landscape even during settlement and roll periods. In other words, the radar stops lighting up, but we're not there yet. And the next detail is what flips the whole setup. You don't, T, need a global crisis for stress to matter. You just need enough stress to force behavior. Let's talk behavior, because this is what actually moves markets. When the cost of dollar hedging rises, foreign investors become less enthusiastic buyers of U.S. assets on a hedged basis. That can change demand at the margin for treasuries and credit. When repo gets tight, dealers pull back. Liquidity thins. Bid-ask widens. Volatility rises. When EM gets hit, portfolio managers reduce risk. That can create mechanical selling in other assets. When commodities get more expensive in local currency terms because the dollar is scarce, demand assumptions shift, inventories get managed differently, and price discovery can get choppy. All of that is the same story told through different instruments, same movie, different cameras. Now here's the psychology shield, because even if you understand the mechanics, volatility will still try to take your lunch money. If you've ever been shaken out right before the move, it is not because you were weak, it is because volatility is designed to weaponize your time horizon. The market's favorite trick is to make you feel late at the top and stupid at the bottom. It gives you a headline on the worst possible day, then it snaps back the moment you capitulate. So you need a clean separation in your mind. Trend signal versus noise. Trend signal is structural. Persistent basis pressure, repeated stress at reporting windows, sustained dispersion, consistent reactions in funding-sensitive pairs. Noise is the daily headline roulette. Tariff tweet, rumor, one speech line, one hot inflation print. Noise can move price violently. Trend signal moves behavior. Your job is to not let noise rewrite your plan every hour. That means risk framing matters. Price can whip around violently, even if the thesis is correct, especially in FX and rates, especially in thin liquidity windows, especially when the calendar is loaded. You can be right about the direction and still get destroyed by the path. So don't confuse I was right with I managed risk. Those are different skills. If you want to survive, you size so you can tolerate being early. You decide in advance what invalidation looks like. You accept that the market will try to embarrass you before it pays you. That's not pessimism. That's professionalism. But that's not the part that matters. What matters is the two scenario lens from here because it keeps you honest and it keeps you from marrying a narrative. Scenario 1 is the controlled pullback and retest. In this scenario, stress signals cool. The basis stops worsening into the reporting window. Repo stays orderly. USD JPY might retreat from the danger zone, maybe drifting lower as intervention fears cap the move. And broader dollar measures like DXY hold above a key support band rather than slicing cleanly through it. If you're thinking in levels, a broad support zone for the dollar index in the mid to high 90s matters because it has acted like a floor in recent ranges, while the low 100s have acted like a ceiling. A controlled retest would look like chop inside that range, not a waterfall. And the message would be, the system is stressed, but it's not tightening further right now. Scenario 2 is the continuation squeeze. This is the one that people deny right up until they can't. In this scenario, the toll booth gets more expensive. Cross-currency basis worsens around the calendar edge. Repo tightness shows up in the places that matter. FX dispersion increases, meaning weak nodes get weaker fast. USD JPY pushes back toward the upper end of its recent stress zone. Think mid-150s pushing toward the high 150s, and every move starts to feel like it ends less, happening on thinner and thinner liquidity. EM currencies that were fine suddenly aren't. Commodity-linked currencies start to behave differently. And you get that classic pattern. Spot looks manageable until it doesn't, because the structure was doing the warning the entire time. The continuation squeeze scenario carries gap risk. It can jump levels. It can happen overnight. And that's where the real pressure starts. So what comes next, concretely, over the next 7 to 14 days? Here's the roadmap without the noise. First, watch the calendar. If you're approaching month end, quarter end, major roll dates, you treat liquidity as thinner than usual, even if your screen looks normal at noon. Second, watch the dollar index range behavior. You don't need to worship DXY, but you respect it as a summary gauge. If the dollar holds above that mid to high 90 support band and fails to reclaim the low 100s, that suggests the headline dollar is not screaming stress, even if the plumbing still is. If the dollar breaks below that support band and stays there, it can signal a broader regime shift. But here's the twist. A lower dollar index does not automatically mean dollar funding is easy. It can mean portfolio reallocation, policy uncertainty, or risk repricing. That's why you watch the spreads, not just the spot. Third, watch USD JPY behavior. In that zone, the market keeps treating like an electric fence. When USD JPY is hovering around the mid-150s, pay attention to two things: the speed of the move and the reaction to official signals. Sharp intraday reversals, sudden rate check rumors, and violent snaps are telling you liquidity is thin and positioning is nervous. A clean break, higher with no reversal and no response, would be a different message. More like the market is steamrolling, which tends to spill into broader stress if hedging costs rise and risk gets delevered. A failure to hold those highs with repeated sharp reversals can cap the move, but also increase volatility, which is its own form of stress. Fourth, watch the plumbing. Repo and the behavior around so-far distribution, not just the average. If you see persistent firmness around key dates, specials, or sudden tightness, that's your radar. Fifth, watch dispersion in EMFX. You're not trying to predict every currency, you're watching breadth. If stress stays contained to a few obvious weak links, that's manageable. If it starts spreading across regions, that's escalation. Sixth, for the metals and commodities crowd, watch for the paper versus physical tells. You'll hear it in premia, delivery chatter, inventory financing talk, and in how spreads behave. When financing tightens, someone always tries to push the pain somewhere else. Sometimes it shows up as tighter availability. Sometimes it shows up as a weird divergence between related contracts. Sometimes it shows up as a sudden scramble for hedges, but it shows up. Now let's define invalidation, because this is where retail gets crushed. They carry a thesis with no off switch. Invalidation is not price went against me today. Invalidation is structural. For the tightening thesis, invalidation would look like stress measures easing through a reporting window instead of worsening. It would look like calmer repo conditions into the calendar edge. It would look like FX dispersion compressing, not expanding. It would look like USD JPY volatility cooling without needing official jawboning. It would look like the toll booth lowering its price. If you see that, you downgrade the squeeze scenario. You don't need to prove anything, you adapt. Because if this one level breaks, the math changes, but it can change both ways. And let me say the quiet part out loud for the skeptical crowd. Yes, institutions have incentives. Yes, markets have structure. Yes, there are times when price discovery is more about balance sheet and hedging than it is about fair value. You don't need to accuse anyone of a crime to understand that the game is shaped by constraints. When liquidity is abundant, narratives win. When liquidity is scarce, mechanics win. That's not conspiracy, that's physics. It's like blaming gravity for falling. Gravity doesn't care, it just is. And the calendar makes gravity stronger at specific times. That's the hidden detail. So, what should you do with this map if you were a retail investor who also watches macro and metals and you re-tired of being emotionally herded? You stop letting one chart hypnotize you. You watch the radar. You build a watch list that respects structure. You decide which scenario you're in, and you let the market prove it with the signals that matter, not with the loudest headline. You accept that the path will be ugly. You size so you can survive the ugly. You stop confusing certainty with conviction. Conviction is earned by stacking proof and managing risk. Certainty is usually a trap. And here is the payoff I promised. The next week or two is not about predicting a magic number. It's about recognizing which side is being forced. If the spreads in basis are widening into the calendar edge, if repo feels tighter on the days it shouldn't, if USD JPY starts behaving like a live wire again, and if EM dispersion broadens, then the system is tightening even if the dollar index looks fine. That's the squeeze setup. In that world, the moves tend to be faster than people expect, and the headlines arrive after the price. If instead those stress signals soften, if the toll booth price drops, if volatility stops feeding on itself, then you're in the controlled retest world. Still choppy, still noisy, but less likely to produce the kind of forced cascading bid for dollars that breaks weak links. Either way, you win by being early to the right signal, not early to the loudest story. And that's just the identity of the people who make it through these cycles. They don't outsource their nervous system to the market. They use the market as information. If you're the kind of person who wants that kind of edge, mechanics over mythology, radar over window gazing, then stick with this community mindset, not because you need a guru, because you need a process. The market is going to keep trying to rush you, shame you, and whipsaw you into bad decisions. Your defense is structure, patience, and a checklist. So remember the map. Dollar stress shows up in the spreads before it shows up in your feed. It spikes on the calendar because balance sheets have deadlines. It spreads through hedges, collateral, and forced behavior. And the next 7 to 14 days will tell you which scenario is taking control, controlled retest or continuation squeeze, based on whether the toll booth gets cheaper or more expensive. Watch the mid to high 90s support band and the low 100 ceiling on the broad dollar gauge as context. Watch USD JPY in that mid 150s to high 150s, danger zone for volatility and official sensitivity. Watch repo and funding distribution for tightness. Watch EM breadth for contagion. And watch commodities for the subtle paper versus physical tells. Because the moment those signals line up, the market stops being a debate and starts being a machine. And that's where the real pressure starts.